Front and center this hour, stocks searching for direction following the Fed meeting and that uncertainty over Iran. We'll trade all of it with the investment committee. Joining me for the hour today, Josh Brown, Stephanie Link, Jenny Harrington, Jason Snipe. Our senior economics correspondent, Steve Liesman, is with us as well. As we check the markets here, we are mixed across the board. So we're thinking about the Middle East. We're apparently 2 weeks away from any kind of decision there, according to the president. The markets obviously are reacting to the Fed meeting a couple of days ago and Powell's comments, which were deemed to be more hawkish than not. Yields are up, maybe representing all of that. Josh, what do I do with all of this?
Well, I think the question of whether or not we can make a new high, I think we have to give that a little bit of time to breathe because historically, it doesn't really happen right away. In fact, that's fairly rare. What tends to happen after a 20% drawdown, when you come all the way back to within 5% of those old highs, is you stall out a little bit. We're coming off of one of the best 40-day periods ever for the S&P. We've had this huge rally from negative 20% all the way back to within a couple of percent. And if history is any guide, the average period of time it takes that you have to stall out just below those highs is about 3.6 months. We're about 1.1 month since we got, within 5%. So just a very quick example that everyone can relate to because it just happened. In July of 2023, I was probably on the show. We were probably having the same conversation. Can we make a new high? We had just come back from that horrific bear market in 2022. And we had to stall out a little bit. It took 6 months in order to get that new high back in the summer of 2023, but ultimately we got it. So it's early. We got to within 5% after just an absolute brutal, very fast but very sharp bear market. We might have to tread water a little bit here, and that would be perfect. That would be about August would be 3.6 months from when we got back to within 5%. So let it breathe. The jury's still out. We don't know if it'll happen, but it's certainly, there's nothing wrong with biding our time at these levels.
Tread water, Steph, because we need to do so. We need to buy ourselves some time, it sounds, until we figure out whether there's going to be this tariff inflation or not. That was the word from Powell. Just continued stay the course, which is stay the course of doing nothing and trying to watch and look around all the corners to see what might be coming. And they just don't know.
Right. We're watching the geopolitics. I'm assuming there's going to be a resolution. So what that means, we focus back on the economy and back on the Fed. The economy is actually doing just fine. We're running at about 2% in terms of GDP. The consumer is hanging in there, despite the soft surveys and the confidence numbers, but they are spending. Inflation is coming down. That's good. I will say there's this one yellow flag, Scott, that's new for me, and that is that the weekly jobless claims.
Yeah, they're elevated.
They're going higher. Now, 240,000 roughly the last 3 weeks is not concerning, but we were at 200 to 210. So just watching the direction and the speed of that, I think 260 and higher will get me more concerned. But for now, I feel okay. And so the pullbacks, I think, in the market are going to be shallow, mainly because there's $7 trillion of cash on the sidelines. What I just mentioned about the economy hanging in and doing fairly well, and that leads to earnings. And I always bring it back to earnings, Scott. I know I'm a broken record on it, but it's the thing that drives stocks on the way up and on the way down. And numbers are going to, I think the second quarter numbers are going to be pretty good. And we only have to wait two and a half weeks for the banks to start telling us that.
Yeah. Tom Lee also thinks that pullbacks are going to be shallow, says buy the dip. He'll be on Closing Bell with me a little later this afternoon, so you can hear directly from him and get a little more granular detail onto why he believes that. Steve, I'm really struck today, I guess, by just a couple of days following Powell, which was clearly deemed by the market to be more hawkish than not. You see the move in interest rates today. The tension between the Powell commentary and the Waller comments that he gave to you, the Fed governor did this morning, they are at odds with one another.
Not so much at odds over the direction of rates. I still think Powell is somebody who thinks, when he says the word modestly restrictive, I think that suggests to me that he's still a guy that wants to reduce rates. The question, I think, the two questions are when you should begin cutting and how much risk do you want to take on ahead of those cuts from the potential for tariff inflation. Waller feels very confident in the idea that tariffs will be a one-time rise in the price level, and he's willing to act on it. I do not think that is a broadly shared point of view at the Federal Reserve Board or the Federal Reserve, or the Federal Market Committee, but I do think that there are others who think that way. And the question becomes, what is the litmus test? What's the bar for raising it? It's actually the question that I asked Powell yesterday. We did get some answer there, where he wants to see, I think, several months where this stuff has increased the price level as expected and not passed through either to other items that are non-tariffed or especially high to the tariff items, and whether or not that has a broad impact. If you read the monetary policy report to Congress today, they did note that there had been increases in goods inflation. It did show up in May, and more is expected. I don't think Powell just wants to take that risk to hike. And plus, Scott, I think the optics really are potentially troubling, right? Is the Fed going to be cutting interest rates in a month when inflation goes up? Waller seems confident or comfortable to do that. I don't think Powell is.
It's not the first time that Waller has sort of put himself as an outlier, especially for someone who was thought to be hawkish, who has made more dovish comments in the past that seem to be at odds with Powell's perspective. He's a Trump nominee. I think that's worth putting out there. I'm not going to suggest that he's auditioning for anything. Even though I just said it, I'm not going to say he is, even though others might take it as that. But he's unafraid to put a perspective out there that would seem to be just at odds with the most recent commentary from the chair himself. That in and of itself is noteworthy.
Yeah, well, let's just be clear. Waller is also someone who expects inflation to rise and rise as a result of tariffs. So that's clear. And Powell is simply not willing, I think, to risk the gains that you've had. And I think it was Mike Santoli was talking earlier. We have lots of evidence that the Fed fights the last war. And that was a war they fought. And they seem to get inflation back under control. And I don't think Powell wants to squander that. There's also, I think, a question about what, Stephanie was talking about, which is how much weakness is there in the economy? When you look around and you say, what troubles me that is a sign that parts of the economy need help from the Fed, or that the rate is far, far higher and restrictive to the neutral rate? Perhaps there is some weakness. You have the problem of graduates not finding jobs. You do have a somewhat elevated, but not alarmingly so, claims numbers. The monetary policy report today to Congress did say that you have not a lot of firings going on, but also much more muted hiring. So there is some softness there. Does any of this tell you you have an emergency? No. So Powell says, you know what? I don't have an emergency. I'm going to wait. Waller says, you know what? I feel confident that we're not going to have a broader inflation problem. I'm willing to cut now.
Yeah. Jenny, how much does the Fed matter right now in the run to new highs and or beyond?
Yeah, I don't think it matters. And I'll tell you why. Because 1 year ago, the 10-year was at 4.35. Today, the 10-year is at roughly 4.35. The Fed cut 100 basis points last year. And the short end of the curve isn't really what impacts the stock market. What really impacts it are 2-year, 5-year, 10-year Treasury yields. And so they didn't move with the Fed cutting. And that's because we have a fiscal spending problem and we have a supply-demand problem for our bonds. So I think what really matters is how the 10-year responds to that. And so what I think could happen is if and when the Fed cuts, maybe there's a near-term psychological pop in the market because, traders like that. But then reality sets in. And if bond yields don't move, that doesn't do anything for corporate America. It doesn't do anything for individuals. It doesn't do anything for mortgage rates, car lending rates, credit card rates. So that's what matters. And so I don't know that the Fed can contend with the bigger problems we have, which is a budget deficit that's totally out of control and a government that's showing no signs of acting responsibly. That's what's going to impact the rates that actually matter to the market.